Hi, everyone. Thank you for joining us this evening. My name is Kelly Blount, and I'm the Program Marketing Specialist here at General Electric Credit Union. We're so glad you've joined us as we have a lot of great content ahead. Thanks to technology, we're excited to be able to connect with you on such a great topic and wanted to thank you all for tuning in from the comfort of your home, work, or wherever you may be today. And with that, I'm going to turn this over to Katie Burba with General Electric Credit Union to introduce herself and today's guest speaker.
Thank you. Yes, we want to welcome Ian Thomas today as our speaker on 1031s. We appreciate his time working with us to share with you information on 1031s and commercial real estate. Ian Thomas is a partner of Cooney, Ferguson, and LeVay Company. He serves as the firm's corporate business organizations and real estate practice leader. Ian has a passion for working at the intersection of law and business. In his real estate practice, Ian represents property owners, developers, and investors in a broad range of commercial real estate matters, including acquisitions, divestitures, development, leasing matters, and real property reconfigurations. He also serves as a 1031 exchange qualified intermediary performing tax deferral real estate exchanges under Section 1031 of the Internal Revenue Code. Ian specializes in advising his clients on the components and procedures necessary to operate real estate holdings as business concerns. In his corporate and business organizations practices, Ian provides general counsel to privately held businesses on a variety of issues, including formation, commercial contract drafting and negotiation, corporate governance, mergers and acquisitions, shareholder agreements, business disputes, and succession planning. Ian specializes in putting the infrastructure in place for businesses to expand according to their principles, plans for growth. And with that, I'll turn it over to Ian.
Thank you, Katie. I really appreciate the introduction, and thank you all for joining us today for this little blurb about 1031 exchanges. As Katie said, my name's Ian Thomas. I'm a partner at Cooney, Ferguson, and LeVay Company, LPA. We are located in Woodlawn, right next to the Century Inn, right where Route 747 and Route 4 split. Today I'll be talking to you, I'll be giving you some of the basics of 1031 exchanges. Mostly today we're going to cover some basic structure and exchange definitions, important exchange rules, threshold questions for exchange treatment, and necessary information for a qualified intermediary to get started on your exchange documents. Now, generally the way that I look at this is, these are the items that I would be asking you if you were to call in and talk to me about whether a transaction or group of transactions you wanted to engage in would qualify as a 1031 exchange. So there's some important terms that we'll need to know and I'll use throughout this discussion today. The first term is the taxpayer, and the taxpayer is the title holder of the relinquished property. We're going to talk a little bit about later about the same taxpayer rule, which is important because in a 1031 exchange, your taxpayer has to complete and end the exchange, being that it has to sell the relinquished property and also be the purchaser of the replacement property. Now, what does relinquished property and replacement property mean? Well, the relinquished property is a property that you are selling to start off your 1031 exchange, and the replacement property is the property that you are purchasing or that might be have been destroyed, lost, or stolen. That's a little bit different, but it also makes sense in the context of talking about exchanges. So relinquished property you currently own as the taxpayer and are selling. Replacement property, property you want to purchase to replace the value of your relinquished property and complete your exchange. Now, before we get any further, I want to make sure that everybody understands a 1031 exchange, what a 1031 exchange is. 1031 exchange is when a taxpayer sells their relinquished property, that is real estate, and purchases replacement property, that is real estate, of an equal or greater value in order to defer capital gains tax and depreciation recapture that would otherwise be repaid at the sale of your relinquished property, or due to the government upon the sale of your relinquished property when you pay your taxes during the next year. So in order to gain full deferral of your capital gain and depreciation recapture from selling a relinquished property, your replacement property, a good rule of thumb is that the contract value of your replacement property should be equal to or greater than the contract sales price, the contract value of your relinquished property. If you are if your replacement property is a little short, let's say that you sell your relinquished property for $100,000 and you purchase replacement property for $50,000. The difference between those two numbers is called boot. And boot is what are taxable funds from exchange transactions that are actually received by a taxpayer, which means you get that money, you take that money directly from your exchange account, or it's paid to you on the settlement statement for your relinquished or replacement property, or that is constructively received by a taxpayer, which means that it was paid on your behalf, or you received a benefit from it. That does not include mortgage payoffs or things that are other permissible closing costs like real estate commissions, attorney's fees, accountant's fees, and qualified intermediary fees. A qualified intermediary is what I do. Qualified intermediary is an entity or a person that holds money or real property to facilitate a Section 1031 exchange. Paramount to a 1031 exchange occurring is that, and being able to qualify and not be disqualified, is that you as the taxpayer can never touch the relinquished property proceeds, or in a reverse exchange, you cannot be the owner of the replacement property until the relinquished property is sold. Or in order for you to fully defer, you cannot touch the relinquished property proceeds, nor can your attorney or your accountant or anyone who works for you. That's called constructive receipt of those funds, and that will be all those funds that they receive or touch will be considered boot. So what does that mean? When you sell your relinquished property, you will have some proceeds, and those proceeds will be wired directly to me as a qualified intermediary from your title agent who closes that property. They'll be wired to me. I will set up an exchange account for you, or we will hold it in our trust account depending on how fast your replacement property is going to close. So let's talk about the different types of exchanges. Let me be very clear. Today, I'm going to be working from a forward exchange perspective. It is the most basic form of an exchange, but it is also the easiest to explain and to understand. In a forward exchange, you as the taxpayer would sell your relinquished property and then subsequently purchase replacement property. That subsequently purchase, the time frame for you to purchase could be anywhere from 1 day after you sell your relinquished property to within 180 days that from the time you sell your relinquished property. And we'll get into that a little bit further when we talk about timing on the next slide. A reverse exchange is an exchange in which the replacement property the taxpayer has targeted actually will close before the relinquished property closes. In those scenarios, a qualified intermediary like myself will hold title to the replacement property through what's called an exchange accommodation title holder, generally a single member LLC. I will hold that until you actually sell your relinquished property, at which time, about 5 days later, or within the 180-day time frame after the purchase of the replacement property, whichever is sooner, I will transfer to you the membership interest in the exchange accommodation title holder so that you then become the owner of the replacement property. So we basically hold the replacement property for you until we can complete the exchange transfers as relinquished property transferred out, replacement property transferred in to taxpayer. So 1031 exchange, Section 1031 exchanges are governed by many hard and fast rules. These rules cannot be derogated from, they cannot be fudged, they can't be, there are no exceptions to them unless the federal government makes an express exception, which actually happened in 2020 due to the coronavirus pandemic. We won't get into that. We're just going to talk about the basic rules today, and I seriously doubt that we will experience something else like that in our lifetimes. So I think it's not that relevant for our conversation today. But let's talk about the most basic rule of a 1031 exchange, timing. For 1031 exchange, you will be required to purchase your replacement property within 180 days of the closing of your relinquished property. That's your first big timing rule, the 180-day rule. That means that whether that 180th day falls on Christmas, falls on New Year's Day, falls on a holiday, any holiday, falls on a weekend, that is your hard and fast date. So you need to prepare accordingly to make sure that you can make your closing date at least within that time. With the real estate market being the way it has been lately, that's not been a real problem. The next timing issue is that you have to identify your replacement properties to me as the qualified intermediary within 45 days of the closing of your relinquished property. So that 45-day timeline and that 180-day timeline run concurrently. They are not, they don't build upon one another. They run concurrently at the same time. What does it mean to identify something? Well, myself as qualified intermediary, I will provide to you, and I'm sorry I'm skipping around here, but this is pretty important. It makes sense to do that here. You have an exchange identification form that I would provide to you. I would provide that to you about 35 days after you close on your relinquished property. So you've had time after closing to look for properties that you are looking to target to purchase within the remainder of the 180 days that you have left in the exchange period. You can identify 3 or more properties without having any limit on their value. I always tell people as a general rule, you should identify 3 properties because one, you have flexibility. If you don't close on one, you can move on to another. To identify 3 properties, you do not have to buy all of them. You only have to buy 1 or 2, or really enough to make up your relinquished property value. And if you identify more than 3 properties, so 4 or more, you're limited to, the value of those properties is limited to 200% of the contract value of your relinquished property. And now, as people who negotiate real estate contracts know, sometimes you don't know what the value of a property is going to, the contract value of a replacement property is going to be, until you actually get down to the brass tacks of negotiating. So this is a very important rule, because if you don't abide by it, your exchange will be disqualified before you even get off the ground. So be safe. Identify 3 replacement properties, unless you have a very, very expensive relinquished property, in which case the 200% rule might not really affect you. I will say that it's also important for you to know, from an exchange identification standpoint, that I'll be holding your money as soon as the relinquished property sells. That money the proceeds from the relinquished property come to my escrow account. If you do not identify an exchange property within the 45 days following the relinquished property sale, closing, I should say, your exchange is automatically terminated at that 45th day, and I will disperse your funds within 7 to 10 days after that fact, after we have figured out our fees for the time we've put in up to that point for a terminated exchange. However, it's very important for you to know that if you do identify, let's say you identify 1 property, and the 45th day comes around, you've identified properly, and then we move on to the post 45 day period. Let's say on the 47th day, someone else has actually purchased that property, and it's not available for you to purchase anymore. Well, in the eyes of the IRS, since that property still exists, it is still available for purchase. So that means that I cannot disperse the replacement or the relinquished property proceeds until your 180th day has run in that case. So another reason to identify more than 1 replacement property, so that if somebody buys out 1, you can move on to another. But also very important consideration in whether you are going to identify any properties at all, because you want to make sure that you're not going to be separated from your relinquished property proceeds for the entire 180 days, if you can help it. So let's go back up to contract value for contract value. I get a lot of questions about 1031 exchanges, and people focus only on the proceeds of their relinquished property and reinvesting them. That is a common mistake, but it is a mistake. For 1031 exchange purposes, you have to replace the entire contract value of your relinquished property for contract value in your replacement property. For example, if you sold a replacement property and you had $50,000 worth of a mortgage on it, sell your replacement property for $100,000, or sell your relinquished property for $100,000, pay $50,000 in mortgage back to the bank. I would receive $50,000 in your proceeds, but you have to buy a replacement property that is worth $100,000 or more in order to satisfy 1031 exchange rules for your maximum tax deferral. So you will have to make up that $50,000 either with new mortgage or new money that you inject yourself into the exchange. That's a very important rule that a lot of people skip over, but it's relinquished property contract value and replacement property contract value must be met, or the replacement property contract value must exceed the relinquished property contract value in order to obtain your maximum tax deferral under Section 1031. Let's talk about the same taxpayer rule now. Same taxpayer rule means that the taxpayer who starts the exchange has to be the taxpayer who ends the exchange. Distilled more down a little bit more, that means that the title holder on your relinquished property deed, that is the taxpayer for your exchange. If it is a man and his wife or a man and his spouse, those are the taxpayers, and their names must be on the replacement property deed. We really get into hot water here with same taxpayer rule. It's pretty easy from an individual standpoint. John Doe sells relinquished property. John Doe must be on the replacement property deed. We get a lot of hot water with the same taxpayer rule whenever we have multiple parties that are members of an LLC that owns real property, and that LLC is selling that real property, and maybe some taxpayers don't want to go along with some members don't want to go along. Well, that LLC is the taxpayer. The individual members are not. So that LLC will need to be the title holder for the replacement property. There's a little bit more nuance to that, but I'm going to move on because I hope that you're getting the basics of the same taxpayer rule. Same name on the deed of the relinquished property needs to be on the deed of the replacement property. We've talked about the 200% rule. There is a rule about vacation homes, which are very important. A lot of my clients will ask if they can sell a duplex that they've held for 15 years and rent it out and claimed on their Schedule E form and purchase a condo in Florida. The answer to that is yes, so long as you actually operate that condo as a rental property, and that for the 2 years following the exchange, you make sure that you only are using that condo for up to 2 weeks a year for personal use. Now, there are some other nuances to that rule as well, but it's very important to explain that there is a limit to vacation home use if you purchase a quote-unquote vacation home through a 1031 exchange. For the first 2 years, you would need to plan that you're only going to use it for 2 weeks out of the year, tops. Lastly is the mortgage boot rule, and this is another kind of misconception that comes up from time to time. Someone has figured out, oh yes, we have to replace contract value for contract value. However, we'll use our same example from earlier. You sell your relinquished property for $100,000. It has $50,000 in a mortgage, so you pay off the mortgage at closing. Your qualified intermediary receives $50,000 in proceeds. Well, when you're replacing contract value for contract value, it does matter where the payment for the replacement property comes. In order to avoid mortgage boot, the taxpayer will have to spend all of their proceeds and put that towards the relinquished property and match the contract value or exceed the contract value of the relinquished property when they purchase the replacement property. That's the easiest way to do it. There are a couple other nuances as well, but suffice it to say, if you are a taxpayer who has $50,000 in their exchange fund, but and you had a $50,000 mortgage, but only want to spend $40,000 from your exchange fund on the replacement property and spend $60,000 in a new mortgage towards the replacement property, that difference in $10,000 is going to be what's considered mortgage boot. You'll also have regular boot because you'll have $10,000 that's just sitting out there in your exchange fund that I'll have to give back to you at the end of the 180 days. So some threshold questions. Section 1031 exchanges only apply whenever someone has been using their relinquished property and plans to use their replacement property for business or investment purposes. So what does that mean? The best way and the easiest way to show that is, oh, I've rented this out to a business to use it as their principal place of business, or I own this and it is a residential rental. It's a duplex that I've rented out, and you can show rental income on your Schedule E, on the taxpayer Schedule E. There are other ways that you can show business or investment purposes. One of them is that you have run your business out of the property that you are going to sell as relinquished property, or you intend to run your business out of the property that you intend to purchase as replacement property. What does not qualify as business or investment purposes are things like flipping houses or developing lots and selling them to third parties. Flipping houses and developing lots and selling to third parties are generally considered inventory, and they are not considered real property that would qualify for 1031 exchange purposes. That's called the dealer in real estate rule. In some instances, you can get around that, and we'll talk about that a little bit when we talk about the next bullet point, which is the held for time frame. So generally, you need to hold a relinquished property and a replacement property for at least 2 years prior to selling it for an exchange regarding relinquished property, or after purchasing it in an exchange regarding replacement property. That has been determined through a few different revenue rulings as a sufficient time for the IRS to be convinced that you held this property for business or investment purposes. Now, the IRS, there are a couple of exceptions to that. One being that the IRS is not going to prevent you from, entering into a deal that's too good to be true. And this has happened a couple times with some of my clients in the past year, which has been that, or year and a half, I should say, which has been that they'll purchase a property and they'll only have held it for a year, but someone will come and make an offer to them unsolicited for double what they paid for it. And the IRS's answer to that is that depending on the facts and circumstances, if you weren't looking for a deal, but a deal found you, and it's too good to pass up, the IRS will view that as a defensible position if they were ever to audit your exchange on the basis of not meeting the held for requirement for business or investment purposes. The next threshold question is the ownership of relinquished property. And that has to go to, one, the taxpayer who will be purchasing the replacement property, but also it has to go to whether an exchange is even possible at all. For example, if the relinquished property is held in an LLC that has 3 members and only one of the members wants to complete and do a 1031 exchange and the other 2 do not, then an exchange probably isn't going to be available unless probably isn't going to be available at all, actually, in that situation. There are some workarounds that can be done, but ownership of the relinquished property is very important from determining the taxpayer to determining if an exchange is possible, and to determining if an exchange if a transaction would even qualify for exchange treatment. For example, a good example of that is whenever related parties are involved. Now, related party exchanges have some really funny requirements. First, you can swap directly you can do a direct exchange with a related party. Now, related parties are defined in IRS code section 276B and 707B. Or, I'm sorry, 267B and 707B. But it's generally people that are in your either lineal descendants or lineal ancestors, or that are brothers or sisters. Mother, father, brother, sister, son, daughter, and husband and wife. Now, those type of parties can engage in a couple of different exchanges, a couple of different exchange-like transactions. The first thing they can do is they can swap directly. One person gives one property to the other person, and the other person gives a different property to the other person. So that's the property serves as relinquished property and replacement property in each of the people's exchanges. If a direct swap occurs, both parties have to hold that property for at least 2 years after the latest transaction. Secondly, you can actually sell a relinquished property to a related party as long as you are buying from an unrelated party. You can do that. That's not a direct swap, but that's utilizing a qualified intermediary. In that instance as well, though, the related party must hold the property that was relinquished for at least 2 years from the closing of that sale. Lastly, and most importantly, a taxpayer cannot sell a sell a relinquished property to an unrelated party and then buy replacement property from a related party. In general, you cannot purchase replacement property from a related party because there are gain shifting issues with that the IRS has identified. Next is to figure out whether the juice is actually worth the squeeze for a 1031 exchange. My fees for a forward 1031 exchange currently are $2,400 for one relinquished property and one replacement property, with $600 extra for each additional relinquished or replacement property. That's my 2022 rates, and those are going to change. Those change every year based on the amount of time exchanges are taking, and based on my rates as an attorney. So don't quote me on that if you call me in 2023. But that's important to know, because the gain, you need to know and talk to your accountant to figure out the gain, the capital gains tax and depreciation recapture amounts that you're actually going to be deferring, to make sure that it's worth it to do an exchange. And in my opinion, if you are not going to defer the payment of $10,000 or more of capital gains tax and depreciation recapture amounts, I don't think that that's my rule of thumb to determine whether an exchange is really worth doing. Just given the fact that you have to jump through all these hoops, you have to make sure that you are complying with all of these regulations. You'll have to engage an accountant, you'll have to engage an attorney, you'll have to engage a qualified intermediary. Those costs all kind of add up. Lastly, very important threshold question, and we've talked about this, I've hammered this a couple times. You need to determine the value of your replacement property and make sure that the contract value of your replacement property is equal to or greater than the contract value of your relinquished property. If it's not, you can purchase multiple properties through to satisfy that replacement of contract value. You can purchase two properties. In our example, if you've sold your relinquished property for $100,000, you can purchase two $50,000 properties as replacement property in order to make to achieve the contract value. If you can make sure that the contract value replacement threshold for your replacement property, I should say. So the next question is, what do you need to get started? Well, first, in order to do a 1031 exchange, to effectuate a 1031 exchange, I'll need you to reach out to a 1031 exchange qualified intermediary. There are a few local intermediaries in town, of which I am one. But you'll need to contact them before you begin the 1031 exchange process, so that they can talk to you about exchange qualification and about many of the things that we talked about in this slideshow today. And the next item, the way that I do things is, once we have a conversation about a potential 1031 exchange, I will send you an email to open up communication with us that explains my fee structure and explains what I need to get started on your 1031 exchange. Because there are certain documents that need to be drafted and provided to you to execute prior to closing. It's very important that you do this prior to closing on your relinquished property. I've had a lot of people call me before and say, oh, well, you know, I just closed on this property yesterday and I'd like to do a 1031 exchange. And unfortunately, that is too late. You have to have spoken with a 1031 exchange qualified intermediary, preferably 7 to 10 days before your closing on your relinquished property, at the very latest 7 to 10 days, in order to get them set up with your relinquished property title agent and to apprise them of the closing date, but also to provide the qualified intermediary with the relinquished property deed, which is how we determine who the taxpayer is going to be. If the taxpayer is an LLC, we'll also need any applicable operating agreements to determine whether that LLC is the ultimate taxpayer, being that it would be a single member or a multi-member LLC, or if it's a disregarded entity, which it would be a single member LLC that hasn't made an S Corp election. Next, we'll need the fully executed relinquished property purchase agreement, because that purchase agreement gets assigned to the qualified intermediary so that I can be provided the 1031, the proceeds from the relinquished property sale. There will be 3 documents that we will draft for a forward exchange, and that we will usually send to the title agent for you to just execute along with your other closing documents. That is an exchange agreement between the taxpayer and myself as qualified intermediary. That's the assignment between the taxpayer and myself as a qualified intermediary, assigning the rights as purchaser, or I'm sorry, assigning the rights as seller under the relinquished property purchase agreement. And we will also send a notice of assignment to be signed by the purchaser so that they can acknowledge that a 1031 exchange is occurring. Those are 3 documents required by Section 1031 to be executed prior to or at closing for a relinquished property. The closing statement also needs to show that the qualified intermediary entity that is serving is the actual seller for the relinquished property closing, and that I usually have my taxpayer sign as read and approved as well, but I will need to sign the settlement statement as the actual seller of the relinquished property purchase agreement. So I'll need your title agent's email address, telephone number, and name. Those items would be in the email that I would send to you, and that you would just reply to that email, CCing my wonderful paralegal, and then moving forward, allowing us to move forward and draft your documents, your exchange documents, prior to your closing, which is required per Section 1031. I appreciate you all sitting here and listening to me drone on about 1031 exchanges, and I'm looking forward to hearing from you if you have any questions or concerns, and or if you have any corrections to some of the information I put out there. I'm more than willing to hear those as well.
Awesome. Thank you, Ian. For everyone on today's webinar, as Ian mentioned, we will now open it up for the Q&A portion. So if you have any questions that came from today's content, we can go ahead and get started with that. I know we have a couple that were pre-submitted as well. So our first question, one second, let me pull it up. It's in reference to the exchange example you described at the beginning with the $100,000 value and $50,000 mortgage. They're asking, do you have to put all of the money as a down payment?
All of the proceeds, you need to apply all of your proceeds to the purchase of the replacement property. If you don't, the difference will be considered boot. I don't know what else you would spend it on. If it just sits in the exchange account for 180 days, I have to give it to you, and it will then be boot that way. So yes, the short answer is yes. You need to apply all of your proceeds to the purchase of the replacement property. Otherwise, you run the risk of being assessed tax on boot, which is usually, my rule of thumb is to estimate about 25 to 30% of the boot amount needs to be paid in taxes. And a big reason for that is because the depreciation recapture amount is the first thing that's applied to boot, and that's taxed at your regular or ordinary income rates, not at capital gains rates.
Thank you. Our next question is, can a bank or credit union be a qualified intermediary?
Yes, they can, if they have the exchange agreement, assignment, and notice of assignment paperwork to do that. They can operate as a 1031 exchange qualified intermediary. Generally, the way they do that is they have kind of a spinoff entity that will handle that, but not a lot of credit unions or banks have those abilities. And you also have to remember that the credit union or bank, if you are doing business, if the taxpayer does business with that bank could be determined to not be an independent qualified intermediary, in which case the exchange any money received by that non-independent person would be considered constructively received, and the exchange would fail.
Our next question is, when it comes to closing on the new purchase, how early in the process should I disclose the exchange to my lender?
As early as possible.
Perfect. Our next one is, what is not allowed in a 1031 exchange?
Well, 1031 exchanges are limited since the 2017 Tax Cuts and Jobs Act, have been limited to real property sales and purchases of real property interest. You can't purchase membership interest in an LLC that owns real property with a 1031 exchange. If you're trying to be a part owner in real property and you want to use a 1031 exchange to purchase that property as replacement property, you have to be a tenant in common owner, which means that your name would be on the deed as an owner of an undivided tenancy in common interest, of a certain amount that's value is equal to or greater than your relinquished property contract value. I think we touched a little bit also on sales of on what qualifies as business or investment purposes. So that real estate has to be held or used for business or investment purposes on both ends. So people can't do a 1031 exchange with their personal residence, for example, or with a vacation home that they haven't used as a short-term rental, or with a house that they purchased 4 months ago, fixed up, and now they are flipping. So things like that, it's very important to talk to a 1031 qualified intermediary if you have any questions about whether your relinquished property or replacement property would qualify. There's a whole lot of nuance that goes into some of that, and really what it rests on is whether you have a defensible position for utilizing a certain property as 1031 exchange property if the IRS comes knocking. And the second question is whether your accountant or whoever prepares your taxes is comfortable submitting the return that lists that 1031 exchange, if that your accountant or tax preparer is comfortable submitting that with their signature on it. That is that's one of the things that really is something that you should talk to, you should take into consideration whenever you're trying to figure out if a property might be able to be squeezed into 1031 exchange or not.
Our next question is, how do I know if my property qualifies, and what are the initial steps, or how do I get started with a 1031 exchange?
Oh, well, I think you'll need to, if you watch this webinar, you have a pretty good idea, but the first step would be give a qualified intermediary a call. Talk to them about your proposed sale of relinquished property and the condition of that property and some of the characteristics of that property, and then also talk to them about the condition and characteristics of your proposed replacement property, and they should be able to tell you within a few minutes whether that's going to qualify, whether your proposed transactions would qualify for exchange treatment or not. They're going to ask you a lot of the same questions that were in this webinar. So if you go back and listen to this and start checking off boxes, that should be helpful to narrow down whether you can, sell some property, buy some property from your neighbor who is unrelated and sell some property to your son or daughter who is related, for instance.
And it looks like we have a couple more questions. So if anyone on today's webinar has a question that you want to get in, go ahead and submit that using your questions feature. Otherwise, we'll finish up with these next couple of questions. The next one being, what are the time requirements in an exchange?
Well, you have 180 days from the sale of your relinquished property in a forward exchange. You have 180 days to close on the purchase of your replacement property. So relinquished property close, 180 days later, you must have closed on your replacement property, or else your exchange is terminated. And even if your replacement property closes on the 181st day, it will not qualify for exchange treatment. Running concurrently with that time frame is a 45-day identification period. Now, if you've already identified what property you want to buy, or what property you want to buy as replacement property before you've even sold your relinquished property, we can write that directly into the exchange agreement. That happens a lot whenever I have people who have entered into their contracts to sell relinquished property and purchase replacement property, but they're set out for a long period of time. And so they already have the contracts in place. They just need a qualified intermediary to hold the funds in the interim between the sales of the sale of the relinquished property and the purchase of the replacement property. Now, if you don't know what you're going to buy whenever your relinquished property closes, if you don't know what you're going to buy as replacement property, you have 45 days from the date the relinquished property closes to identify replacement property or properties. I always suggest to identify up to 3 to give yourself some flexibility, but also to help you be able to move if one of your exchange replacement properties gets bought out from under you, or if you need to buy more than one property in order to meet your replacement property contract value threshold, which is equal to or greater than your relinquished property contract value. So 45 days to identify, which runs concurrently with 180 days to close on one of those identified properties.
And then this will be our last question. It's asking, is it possible to exchange out of one property and into multiple properties?
Yes, it is. You can exchange into multiple properties. You can identify really as many properties as you want. Just if you identify 4 or more, you're constrained by a couple different rules. First is the 200% rule, which we discussed earlier. The aggregate value of your replacement properties cannot be 200% of the contract value, cannot be greater than 200% of the contract value of your relinquished property. The other rule is that if it does exceed 200%, then you have to buy all of them. It's like shooting the moon in hearts. So you can purchase multiple replacement properties, even if you only sell one relinquished property. The goal is to replace the contract value of your relinquished property with contract value of replacement property or replacement properties. Now, if you have an additional replacement property, your exchange fee will generally be increased depending on the amount of exchange properties or replacement properties you want to purchase, or the amount of relinquished properties you want to sell, because you can also sell multiple replacement or relinquished properties and exchange into one replacement property. I'm sorry, let me say that one more time. You can sell multiple relinquished properties and exchange into one replacement property as well.
Awesome. All right. Well, thank you, Ian, for being here today and taking us through the content. That was our last question, so that's going to conclude our Q&A. Thank you all for joining us and have a great rest of your day.